All right, so we are going to be discussing candlesticks today. So what is a candlestick, right? So candlesticks are basically the building blocks of every chart you'll look at. They tell you exactly what happens in a certain time period, whether it's a 1 minute, 5 minute, hourly, whatever time frame you're on, and they show the fight between the buyers and sellers. All right, so let's break this down. We have two types of candles. We have bullish candles, which are usually symbolized by being green, and we also have bearish candles, which are symbolized by being red. Bullish and bearish is a concept in the markets where bullish means that price is going to go up and bearish is that price is going to go down. A way you can kind of remember it is that a bull has horns and horns point upwards. So you can say that, oh, price goes up. But after studying the market and being on the charts, you're just going to know that bullish means price goes up and bearish means price goes down. All right, so now let's talk about the actual structure of a candle. So in order for a candlestick to form, it has to first open. So you can see the candle opens right at this bottom. And one thing you're going to need to know about candlesticks is that they make up every single time frame the same exact way because time is fractal, right? So if you have a daily candle, that daily candle is going to be made up of 6 4-hour candles, right? Or maybe 2 12-hour candles. The candlestick structure is the same throughout the time frames as each candle is made up of lower time frame candlesticks. It might sound confusing now, but I'm going to go ahead and break that down later. All right, so let's say we're looking at the 1 minute time frame. At the start of the minute, the candle is going to open. And in the next 59 seconds of that candle opening, price either can go up or it can go down. So since we're in the 1 minute time frame, after 1 minute, the price would close. And the thing with candlesticks is that price doesn't necessarily need to close higher immediately. A candlestick, it's like a journey. You might start here, you might end up down south, you might later end up going somewhere else, but at the end of the day, your final destination is that close period. And this structure basically makes up a candlestick. And the only difference between a bullish candle and a bearish candle is that with bullish candles, the price closed higher than its first open. So if price closes higher than it first opens, we can see that price went up. And with a bearish candlestick, the price closed lower than when it originally opened. So let's say it opened up at $1,000 and closed at $900, then that's a negative movement. That's a bearish movement. The best way I can describe candlestick formation is just by using a day in your life, right? And what I mean by day in your life, let's say you wake up and you check your phone. You have $100 in your bank account, and then you realize it's the first of the month and you have to pay your rent. And in this case, your rent is $50. So now your bank account has $50 and you realize you're broke. So you go to the casino and put $50 on red. Actually, you put it on black and it hit. So now your bank account is $150. And now after your trip to the casino, you get hungry, you get home, and you realize you're too lazy to cook or go get food. So you decide to just DoorDash, which costs $25. And after that, you decide to go to bed and end the night. So since the food costs $25, we can deduct that from our bank account. And now our final bank account balance for the day is $125. So now let's actually look at this from a candle perspective. So we open the day off with $100. This price is $100 right now. So our open is $100, and then we lost $50 for paying rent. So our candle wicked down all the way to the $50 mark. And after that, we went to the casino, and now our bank account has $150. So we can see that price is all the way up here at an all-time high at $150. But the day's not over yet, and we did have to get food, which was $25. So now price moved down and our bank account balance is at $125. So we started the day with the 100, we lost $50 and got to an all-time low of 50. We won it all back. Our bank account was at 150 at one point, but we ended the day off with 125. This is an example of a bullish candle. We opened with $100 and we ended the day with 125. So we ended up in a profit. Now the same thing would happen on the reverse side. Let's say we opened with $100, we reached a low, we lost all our money, and then we gained it all the way back up. We went high, and at night we decided to be stupid, order a ton of food, and we ended up with a $50 balance. So price would have opened at 100 from the day, and we would have ended with the 50 balance. That's a net negative. So that creates a bearish candlestick. I really hope that explanation made it clear to you guys the difference between the two candlesticks. But now I actually want to show you how it actually applies in real time. Now I'm going to show you the power of the higher time frames and show you that individual lower time frame candles make up the one higher time frame candle. Sounds like a tongue twister, but it's really not that complicated. So I'm in the hourly time frame right now. Now, if you look at the bottom of the screen, you can see that this candle represents March 5th at 4 p.m. So this hourly candle is the 4 p.m. candle, which shows the open and close of that hourly candle. So if we zoom in a little, we can see that this is where it opened. We close down here since it's a black candle, meaning it's a bearish candle. We had highs here and a low here. Now what I'm going to do is I'm going to go into the 15-minute time frame, and we know that 60 minutes makes up an hour, so that means there are 4 15-minute candles in an hour time frame. So if we go to the 15-minute candle, we can see that these are the 4 candles that make up the hourly, right? We know that 4 times 15 equals 60. So these 4 candles is I want you to look at. So with this, we can see that with the first candle of the hourly time frame, we took out the high. So what this means is that in the hourly time frame, that high was taken in the first 15 minutes of that candle being made. And then in the second 15 minutes, we can see price went down. The third one, it went down. And on the fourth one, that's when it peaked at the lowest right down here, but ended up coming up and closing. So hopefully you can see that these 4 15-minute candles makes up this hourly candle. As you can see, we opened here. This was the high. This is a low and this is a close. And when we switch over to the 15 minutes, we can see these 4 candles that make it up. We have the high, we have the low, we have the open, and we have the close. Now, what I want you guys to do from now is get comfortable with this whole concept. I want you to go in the charts and I want you to look at the daily time frame and see up all the hourly candles that make up the daily. I want you to go into the 30-minute and see all the 5-minute candles that make up the 30-minute. And I really want you guys to get comfortable, because when we are actually trading, we are going to be checking out multiple time frames simultaneously. So first we might check out the 4-hour. We might check out what the daily's doing. Oh, let's say market opens. We might want to hop onto the 1-minute or even the 30-second candle. And just remember that time is fractal. So all these candles are going to end up playing in the same exact pattern. You just have to get comfortable with switching between and realizing that one higher time frame candle is made up of a bunch of lower time frame candles. Yeah, that pretty much wraps up the candlestick segment. Now we're going to go ahead and move on to market structure. So I'll see you guys in the next video.